Welcome back to JPX Energy Market Weekly Updates. Crude oil futures raced higher on Tuesday to touch an 8-month high amid broad risk-on tone across markets. The intermonth spread were higher than the previous week, with the JPX Dubai prompt month and third-month spread last traded at around $2.50 a barrel. This is in line with a steep drop in crude oil stocks over the last couple of months. OPEC cut efforts combined with still resilient demand than most think are leading to a steep drop in crude oil stocks in onshore tanks and in the water, according to tracking data from Vortexa and Refinitiv. As you can see from the left figure, as of August, the implied crude shortfall accelerated, with the latest 4-week average showing draws close to 5 million barrels per day. About 2 million barrels per day come from onshore tanks, and an even bigger figure is emerging for crude oil at sea. When oil inventories are low, prices and volatility tends to be higher. The following table shows crude output by the OPEC in August and July, according to a Reuters survey published last week. The 10 OPEC members bound by the deal maintain strong compliance with agreed cutbacks and extra voluntary reductions. OPEC's output is still undershooting the targeted amount by almost 800,000 barrels a day, mainly because Nigeria and Angola lack the capacity to pump as much as their agreed level. Top exporter Saudi Arabia kept August output around 9 million barrels per day as the country extended the voluntary 1 million barrels per day output cut for a second month to provide extra support for the market. Despite ongoing cuts, OPEC oil production rose in August as Nigeria and Iran's production increased, largely offsetting Saudi Arabia's cuts. It's likely that OPEC's oil production will hold broadly steady during the rest of the year. Last Friday's U.S. job report would show the employment rate ticked up in August, while a healthy 187,000 jobs were added to mark the latest evidence that the economy, while still resilient, is beginning to cool, underpinning hopes that the Federal Reserve will hit pause on rate hikes at its next meeting later this month. On the Chinese side, in addition to the recent economic stimulus plan, the market is also focused on the insurance of the third batch of refined oil product quotas. As we move towards autumn and winter, seasonally, we could see weakened demand for gasoline and increased buying for diesel. Whether China maintains strength in crude oil buying will largely depend on whether its refineries continue to export large volumes of diesel. The third batch of export quota for refined oil products totaling 12 million tons is larger than expected. This should be enough to counteract refineries elsewhere entering an elevated maintenance period during September and October, resulting in expected downward pressure on diesel cracks. However, accelerating refinery processing will simply push the shortage upstream from the fuel market to the crude oil market, and the supply and demand balance for crude east of the Suez Canal will be relatively tight, so the Dubai crude oil price will continue to show strength relative to Brent. Okay, that's all we have for this week. Welcome back next week.